In Houston, a company once sold itself as the future of energy. Wall Street loved it. Politicians praised it. Employees bet their retirements on it. Then almost overnight it collapsed. Behind the innovation was hidden debt and manufactured profits. Enron was born in 1985 from the merger of Houston Natural Gas and Internorth. Kenneth Lay became the face of the new company, connected, respected, and politically influential. At first, Enron looked like a normal energy business, pipelines and natural gas infrastructure. But in the 1990s, Enron didn't want to be a boring utility company anymore. It wanted to be a market maker, a financial powerhouse that traded energy like Wall Street traded stocks. Jeffrey Skilling joined in 1990 and pushed a bold new identity, Enron as an energy trading giant. Enron Online helped build the myth: faster than rivals, smarter than everyone, unstoppable. Investors bought the story energy as a financial product, scaled into something enormous. By 2000, Enron reported over $100 billion in revenue. The reputation looked untouchable. The first crack wasn't one bad quarter. It was a system where perception mattered more than reality. A key tool was mark-to-market accounting, controversial, powerful, and easy to abuse. Instead of waiting years, Enron could estimate future profit and record it early. In 1992, the SEC approved Enron's request to use mark-to-market for certain activities. That approval wasn't illegal, but it opened a door. Assumptions could become earnings. If you could make the future look great on paper, you could book profits today. Then came the culture, relentless growth targets, and internal pressure to deliver numbers. Enron's performance reviews were brutal, ranked employees and pushed out those at the bottom. Success meant hitting targets, not explaining risk, not admitting uncertainty. To keep the story perfect, Enron relied on special purpose entity SPECs. SPEs aren't automatically illegal, but Enron used them to hide debt off the balance sheet. Then Andrew Fastow, Enron's CFO, built partnerships like LJM1 and LJM2 doing deals with Enron. By 2001, the illusion was harder to hold. The stock slid. Questions started to pile up. Enron sounded confident, but the structure underneath was becoming unstable. In August 2001, Jeffrey Skilling abruptly resigned as CEO, shocking investors. On Wall Street, the sun's itched trigger one fear. What did is coming? Around the same time, employee Sharon Watkins raised serious concerns internally. She warned Kenneth Lay the company could implode in a wave of accounting scandals. In October 2001, Enron announced a major charge against earnings tied to partnerships. Soon after, it disclosed it would restate financial statements past numbers couldn't be trusted. The market panicked. Credit ratings fell. Counterparties demanded collateral. For a trading business built on trust, that loss of confidence is lethal. Federal scrutiny intensified. The SEC opened an investigation in October 2001. The Justice Department moved in. Enron's statements turned from marketing into evidence. In November 2001, restatements grew, liquidity dried up, and the situation spiraled. A proposed rescue deal with Dynegy appeared, then collapsed. On December 2, 2001, Enron filed for bankruptcy, then the largest in U.S. history. The fallout had names and faces. Thousands lost their jobs, and many lost retirement savings. Employees with 401ks heavily invested in Enron stock watched years disappear. Investors were devastated. A stock once celebrated collapsed 2 pennies. Then came the legal reckoning: who built the maze, who profited, and who signed off on it. Andrew Fastow pleaded guilty in 2004 and later testified against others. He was sentenced to prison. In 2006, Kenneth Lay and Jeffrey Skilling were convicted on multiple federal counts. Lay died before sentencing, and his conviction was later vacated because he died before appeals finished. Skilling went to prison, and his sentence was later reduced after legal developments and an agreement. Enron's auditor, Arthur Anderson, was also pulled into the storm. In 2002, Anderson was convicted of obstruction tied to document destruction. The U.S. Supreme Court overturned the conviction in 2005, but the firm effectively collapsed. Enron helped reshape corporate law. Sarbanes-Oxley passed in 2002 to tighten accountability. Enron wasn't just one company lying, it showed how a lie can become a business model. Complexity became camouflage, and prestige made doubt feel unacceptable. The unsettling part is how normal it looked while it was happening. It wasn't one decision on one bad day, it was years of incentives rewarding appearance over truth. Analysts wanted a miracle. Executives wanted the stock price. Employees wanted stability. In that environment, skepticism becomes unpopular and sometimes professionally dangerous. When trust is the product, losing it is instantaneous. A trading empire can't survive a week of doubt. Enron became shorthand for deception. The real warning is the pattern results too perfect, answers too vague. If you were their employee, investor, analyst, at what moment would you have seen the illusion?